Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show, we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on ospreystrategic.org as well as StockCharts.com. This week I want to cover off the simple principle that the knife cuts both ways. Many of us know that, but just the number of questions I've had this week is it over? Can I get back into the market now? This is a really important time to be aware of what the charts are talking about generally. And, there's always a first. Is it different this time or is it the same this time? What I really want to demonstrate is the problem of thinking we know when the bottom is in within a week or two. And hopefully I'll make some good points here, salient points. The real difficulty that we need to understand is as we approach the end of the year, things change for a corporation. First of all, they have to start updating their year-end targets. They will also have to change some of their accounting for things that could work out either way. Then all of a sudden, as they get forced towards year-end, they kind of have to bring those things into focus. So all of those things are coming at us. The second component of that is that while we are in this inflationary period, and let's pick automobiles just as an example, currently automobile pricing has expanded dramatically, and if I wanted to go buy a new car, let's just pick a number for an $80,000 vehicle, it might be $100,000. So that is a big deal. Now, here's what happens is if you know that there's not enough vehicles out there in your company, what are you going to do? You're going to order pickup trucks, you're going to order more pickup trucks, and you're going to order more pickup trucks just in case as the trucks come through, you could cancel the order, but what you want to do is make sure that the market, that you can get what you need. So then all of a sudden the economy comes racing to a slowdown, either due to things like interest rates or change in business, like all of a sudden your business slows down and the phone's not ringing as much as it was. So you decide to cancel a few of those orders, and that all of a sudden starts to shake out along the way. When that happened before, and this was in 2000 and 2008, we had this really effervescent situation where the market felt almost invincible and it's different this time and all that kind of stuff. But one of the big things that happened late in the fall of 2007 and in the the fall of 2000 and the summer of 2008 was that the CEOs started to realize that things were changing under their feet and they were getting worried. Now, we've already had the CEOs tell us that things are really, really different this time, and they're not very comfortable right here. So as this situation persists, at the end of the second quarter earnings now behind us, if companies start to guide for the third quarter and start to guide lower and say, we're going to miss our numbers, and they're already saying, we don't want to give estimates for future dates, this is where the market really changes. And the reason for that is the price earnings ratio was high, and so we brought that down. But if all of a sudden the earnings come down, then we want to bring that multiple down. We don't have to drop the price earnings multiple, we just have to bring it back in line with the new level of lower earnings. In that scenario, what happens is the whole market does a big step down. So this is an important time to be aware of the chart shapes and why I don't want to get too bearish or too bullish, but being really firm here either way is a very risky idea. So you do not want the knife to cut you by leaving you out of the market forever, and you do not want the knife to cut you by staying in the market as the market breaks lower. In a bear market, we have a downsloping 200-day moving average, so we're calling it a bear market until that changes. So let's talk about a few things. The market is testing the 100-period moving average. I want to show some charts in my recessionary chart list that clearly look difficult. I want to describe my experience losing money in Apple back in 2007, 2008, and how BlackBerry looked to be the shining star back then. And we all know what happened in the end. But my point would be BlackBerry looked wonderful and Apple looked not nearly as good, even after Apple had already brought out the iPhone and the president of BlackBerry had said, yeah, I haven't even looked at the iPhone. I don't really care. We've got a great phone. That kind of stuff was going on 6 months apart, and we all know how it ended up. So just because a chart looks good today does not mean you're in the right chart for the long term. I want to compare that to other market areas now. And some of this insight comes from listening to other speakers, other presenters, and I don't want to scare people, but I do want to show them the current chart. I want people to avoid listening to a CEO. He's never going to tell you to sell the stock. He's always going to tell you things are going to get better tomorrow, even if they're not great today. That's his job or their job or her job. So we need to use the charts and see what investors are doing with their money. Okay, if you like what I've got to say today, perhaps go and check out the offerings at ospreystrategic.org. It's only $17 a week for the annual membership, or try a 1 month at just $7. And again, the idea is to give you an idea what we offer. Real quickly, we have two of us giving technical analysis. Each week I do a newsletter and a video on the weekend, one day a video, one day the newsletter, and get you all set up for what's happening. The monthly recorded conference call, we just finished one, and anybody who wanted to go check it out, it's sitting there available for people to catch in the recording of. And we always try to send out 5 trade setups every day, along with an idea of what we see for market momentum. And we think that's a pretty important component. Okay, let's jump into the chart. So first of all, this is my recession watch list. And I've been through this chart a few times, but it's really starting to change now that we've entered the summer months. And I wanted to bring people up to speed. So first of all, the black boxes are where the PPO is rising, which means the consumer price index is rising, and this is 1968, 1973 to 75, 1977 to 1979. And the point I want to make is a lot of times when this PPO is rising, so when we're still in the upward trajectory of inflation, the market is pulling down. Now, eventually what happens is the market hits its low even before we get our PPO cross. So we don't have to be, it doesn't have to be lower. It just has to be, the momentum has to stop going higher. And I think that's a really important component. Now, in 1979, 1980, what happened here was this was still running up. The market went on a run, and then after this started to come down, and this was the Paul Volcker fight of inflation, the market got hit pretty hard. Well, here we sit with the situation where inflation's rising. The equivalent of Volcker's Jay Powell says, I'm going to crush inflation to make sure it's not a problem for us. And as he says that, we've already had a 30% pullback in the markets. So how are we going to get around that? My point would be this chart does not look finished yet at all. The next chart I want to talk about is wage earnings. And what we see here is this is still accelerating a lot. And one of the things we noticed back in 07, 08 was wages really started to accelerate or the momentum started to accelerate a lot as the stock market declined. So we have a big decline here. But the real question is, as long as this is still accelerating higher, we're probably got a situation which is going to make the market much more difficult. So it's important to recognize the periods in late 60s, mid 70s, and even the late 70s, although the stock market was able to climb. as these things were accelerating. I don't think that's where we're at. So want to be aware of the change. And again, as this consumer price index for wage and clerical workers comes up, and as it starts to roll over, let's just pick whatever this top in here, taking it down, that pretty much marked the lows as this started to roll over the rate of change. So that's something we could look forward to. We don't have that yet, but we want to watch that. Looking in on housing, this is clearly breaking down. We're well below this moving average, much like we were in the 06-07 period and in the late 90s. And in 73, 74, 75, this was moving lower. We seem to be in that sort of situation. So I don't have a whole bunch of comfort that the housing market is where we're going to find our next area. Industrial production, I've mentioned it before, is rolling over slightly, so that's a bigger deal. Looking in on the banking, this is kind of an important slide. What we'll see here is in 07, 08, this was gently going down, and then all of a sudden it had a big wrinkle. Now we know we ended up with a financial crisis. Nobody's predicting a financial crisis because of the change to the systemically important banks. So as long as that changes this should be fine, but it doesn't mean the banks are healthy yet. And the other thing, we're well below the 40-week moving average on this bank index, and there's no real, no real way for this chart to start looking optimistic until at least some of these other indicators start to improve. So currently that one doesn't look very good for us. Looking in on the transportation stocks, the airlines are still trying to hold this uptrend. If this broke again meaningfully, I think that would be a problem. We saw it back in 07. The airlines broke down as part of the economic breakdown. Looking in on autos, we're just coming up to the bottom of the 40-week moving average. This chart's heavy on Tesla, so we have to be careful. But we see in 07, 08 that the autos rolled over, and it wasn't a very good place to be. 04, 05 was a big bull market for stocks, but yet the automobile underperformed. So we can't use it by itself. The problem is when we compare it back to some of the other big breakdowns in history, this this tends to be a pretty meaningful one. So I don't have the data from before 2000. But what we can see here is it was below the 40-week moving average for most of the trip down in 2001, 2002. Just telling us to be more cautious. PPO is below zero. If it oscillates below zero, that's going to change things a lot. So as I described in the opening, when all of a sudden people start to cancel car orders and that kind of stuff, that will change how the CEOs see the future quite quickly. Looking in on the railroads, we're trying to hold this giant uptrend line, but we are below the 40-week moving average. I want to point out one thing that happened just today. Dollar tran, and not just on the railroads, but on the transports themselves. If you just go to the daily chart, what happened was we had a huge reversal right up here around the 100-period moving average, suggesting, and the transports, even on I'll call it relatively close basis to the market, like a daily basis, we should see the trucking and the transport start to outperform. So here we have the trucks getting towards the 40-week moving average and roll back down. That's not a good look. So we're still in a situation of the transportation sector telling us that there could be a bigger problem out there. When we get into the bonds, there's lots going on in the bonds. The point I want to make is 05, 06, 07, this was still running up, and it was actually after the IRX, the 3-month Treasury yield started to roll over that we really saw this. Well, we're actually up here, and we're kind of stalling now up around the prior highs that we saw in 2019. I can't really say that this is indicative of what we'd see, but we've got other bond charts in here. Here's the 10-year minus the 3-month, and this is turned up, but the recessions actually start when this difference between the 3-month and the 10-year starts to roll down, and we haven't even started that process yet. So if we're going through that period in in 2000 or in 2007, 2008. This is a pretty important inflection and an important piece of data that, you know, the stock market can wind down pretty meaningfully as this goes lower. And so I'll just leave that there. When we get into the, I thought I had a few more in the bond markets. There they are. When we get into the 10-2s, we are in a period where this is deeply depressed. So what does that mean? Well, just look back in history, 89 and 90, we had a sideways chop to the stock market for a while. 2000 to 2002, way over here. So while this thing actually accelerated higher, it was difficult for the stock market to improve. We're still on our way down, so we haven't even started the turn. Looking in on the 10-2, I think the only thing I did on this chart was I changed the display settings. Let me go to the 30-year. You can see how compressed all of this data is. So we've got the inverted yield curve all over the place. That one's kind of an important one. But when we look at the 30-10s, this is just, here's the large cap, the German stock market, and the Nikkei. I think if these large trend lines all break as a unit, we need to be very aware that when they broke as units before, and I mean, we've had a pullback, but we still have the uptrend intact, this would be the next level of really starting to watch the problem. And we also noticed that in 07, 08, things got very tight, and then as it widened back out, that was when the problem started to show up. I've mentioned that before. Looking in on the 30 minus the 3-month, what you see here is in 2000 and 2001, this bottomed out and then started to shoot up. And again, the stock market ended up bottoming. Well, the S&P bottomed in early 2003, but the NASDAQ bottomed in October 2002. So when this looks ready to roll over, that's when the party's over, or the bear market. So here's the 2007, 2008 period, and I know this was accelerating up in here since the early part of 2000. The real question I have is do we think this is done now? And we did see some of these big kind of jagged moves in 2008. So this chart would almost say, gee, things could be okay here. It's the rest of the charts that I would suggest don't give us that same kind of comfort level. When we look at the 3-month minus the 10-year, you can see, you know, all these periods where they broke above that zero level. Actually, I've displayed this chart the other way, so I'm just going to leave this one. Broker dealers is another one that I've got here, and it's trying to hold the 10-year trend line, but we're back under the 40-week moving average. And the timing of the video today is to talk about that bottom test of under the 200-day moving average. And if you're going to test and then start to fall away, that's when we really start to notice the difference. So this is a pretty important place in the market. Personal consumption continues to rise, so we're not seeing anything here yet. This is data as of June. And then unemployment claims, this is really starting to change, and this is very recently. So I've displayed it as inverted, so it shows the same as the stock market, but you can see when this starts to fall, and particularly when it gets under the 40-week moving average, that's probably a more important place. Well, in here it jogged around there for a year. So can we use it as a fine line? No. But in what we've got right here is this situation where it's just about ready to fall below that level. And that data was July 22nd, so it's weekly. So just keep watching this and see if that's the big unwind. And again, while that data started to collapse, that's also when we saw the 07, 08 period breakdown. PPO is just going below zero. Most of the big recessionary periods had this PPO in negative territory. Again, we're just going there here in the last couple of weeks. So are we just starting the road into that? University of Michigan sentiment. we're way down here. We're down at some of the worst levels we've seen compared to 1990, even 2000. It was dropping, but from a very high level, and we had a big recession. Well, we're dropping from a very low level. And so, is it over just if we start to turn up here? Well, I don't think that's what we're expecting if the labor market's just starting to pick up unemployment. And lastly, is the PE ratio of the stock market compared to the S&P 500. And what you see here is we're still sitting at a very high level. And if all of a sudden we start to see the actual total earnings drop, and that's been a big talk about how analysts are starting to lower their expectations for earnings so that companies can continue to beat their expectations. They might be lower, but they'll continue to beat them. Well, as we drop this level of earnings, then this might step down to, let's say, the next level lower. Okay, I mentioned Apple, and one of the things I want to point out, so in 2007, Apple was a wonderful stock. It was doing very, very well, and in early 2007, it came out with the iPhone, and it ran up to $202, and all of a sudden, I owned this stock, and in a couple of months, this thing had plummeted down to $115 from $200. I was trying to figure out how I could be in one of the best stocks in the world and losing money. And so that was really when I decided to take on technical analysis more seriously. And these gaps in the stock are when they've done the splits. Now, if we go look at BlackBerry, I'll just use the US listing. So underscore, what I want to show here is in 2007, BlackBerry was, in midsummer, it was really, really high. And then 2008, it was still way higher than Apple was at the time. And then it came down from $148 to $35, and obviously that train never got back on track. But the point being that, these uptrends were just starting to break mid-2008, and that's really when everything broke loose. So we're sitting at that level on a lot of these charts. You're sitting there looking at a company with some of the best phones in the world at the time coming out, profits rising every quarter, and yet the stock undergoes a pullback, call it from 200 to 80. That's a big deal. And so each time we go through this market change, it's important that, yes, companies can still have increasing earnings and profits, but if the overall economy is pulling down, the stock is probably going to get hit as well. And you see this back in 2000 to 2001, where the big pullback was for Apple. That was early. And then what you saw is it didn't do anything for almost 3 years. I mean, it bounced between 13 and 27, 100% gain, but really didn't break out of this until 2004 was when it finally got going again. So the picture isn't that bright for names like this. Lastly, the bigger picture, if you listen to some of the presentations out there, I want to talk specifically about the marijuana names. And what I had, I did have this queued up and screwed it up. One of the things that we see is, just quickly got to find it, is this. I listened to a podcast about Todd Harrison, who is part of the MSOS ETF. And right about here, he was very, very sure that the bottom was in for cannabis and things were going to start to rock higher. And let's just say his timing was probably not great, because he actually was saying that as the stock market topped. Well, this is $33 in the time he was talking in around 25, 26. Things dropped down to $10 from there, not even 9 months later. So even the best people with good intentions thought they were near the lows, and then the whole thing blew out on them. So try not to get caught up in what the corporation says and how bullish they are. And I saw somebody else saying, these insiders are buying this stock over and over and over, but I'm down 50% since I started buying it. I would just say to try and let the charts do the talking, and when they start to make turns higher, then we can start to get involved. But if you're sitting here watching the news and watching CNBC and having a CEO come on and praise his stock, you need to go back and look at Intel and John Chambers and Sun Microsystems and all these guys from the year 2000. Hear what they said on their conference calls, and then 3 months later, they were apoplectic about how much the business had changed, and all of a sudden their order book was canceled. So keep that in mind. I don't know if we're there, but the point I want to make is if we're there, we're about to go through that inflection sometime in the month of August, and that would be a very big deal. So with that, I'm going to sign off. I really want everyone to make sure that they're aware of how difficult the market can be here. And if you've got any further questions, hopefully I can help answer them. Feel free to give our trial offering a shot. And best wishes for the next couple of weeks. We'll talk to you soon. Thanks. Bye-bye.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.